Resilience spending is rising, but coordination is lagging. Corporations are investing more, but not in an integrated way. Corporate resilience spending is escalating as physical, digital, and supply chain risks converge. Physical climate risk is now a board-level issue. A recent MSCI survey found that 85% of companies quantify potential losses from extreme weather, with more than 80% reporting actual impacts to operations or supply chains from events such as severe storms, 62%, and flooding, 47%, over the past 5 years. Firms are assessing risks, with 94% conducting or planning site-specific risk assessments and 76% instituting formal frameworks for physical risk management. Yet, risk horizons skew short-term, 2 to 5 years, suggesting resilience investments are tactical rather than deeply strategic. At the same time, research underscores the economic benefit of resilience investment. Analyses by the U.S. Chamber of Commerce and allied organizations found that every $1 invested in disaster resilience can save up to $16 to $33 in future economic costs, depending on risk and community context. Despite this evidence, the rise in spending has not yet translated into coordinated enterprise-wide risk mitigation. Resilience spending is fragmented across domains. Corporations are increasing expenditures on a range of resilience levers, from physical infrastructure hardening to cybersecurity and supply chain redundancy, but these investments often remain siloed. Physical climate events like hurricanes, floods, and wildfires drive resilience investment in facilities and infrastructure. Cyber threats continue to expand. Nearly 4/5 of organizations expect their cybersecurity budgets to increase, even as only 2% say they have implemented enterprise-wide cyber resilience. The average cost of a data breach remains in the millions. Insurance markets are adjusting to elevated loss trends. Industry outlooks highlight ongoing transformation in underwriting and risk pricing, which is keeping resilience considerations top of mind for finance and risk teams. These domains, physical, digital, financial, are increasingly interdependent. Yet corporate spending decisions rarely bridge them in a coordinated manner. Climate risk is increasing corporate exposure. Climate risk projections amplify the need for integrated resilience. Global losses from natural catastrophes, including hurricanes, storms, flooding, and wildfires, are trending upward. One reinsurance analysis estimated $145 billion in insured losses for 2025, up roughly 6% from 2024, with total losses, insured and uninsured, significantly higher. The rising cost of climate-related events is a structural driver of resilience spending, but also of fragmentation. Investments in asset protection, flood mitigation, grid hardening, and business continuity are often evaluated separately within functions such as facilities, energy, and IT. Why coordination matters? When resilience spending is fragmented, organizations risk losing systemic efficiency. For example, infrastructure investments that mitigate flood risk may not be synchronized with energy reliability strategies or supply chain planning. Cyber resilience upgrades may focus on perimeter defenses while neglecting operational technology, OT vulnerabilities tied to energy systems. Cost centers like finance may approve reserve increases for insurance without linking them to long-term mitigation measures. Despite the evidence that resilience investments deliver economic returns, such as significant future cost savings per dollar invested, many companies still lack integrated frameworks that link spending across risk domains. The strategic gap, from awareness to integration research, shows robust risk awareness. Most surveyed companies quantify physical risk, prioritize hazard response, and see value in resilience investments. Yet the emphasis on short-term risk horizons and functional silos suggests that coordination mechanisms lag behind both risk exposure and investment intent. For executive leadership, the strategic imperative is not simply to increase resilience budgets. It is to embed coordination mechanisms that drive cross-functional scenario analysis, physical, cyber, supply chain, integrated capital planning across resilience domains, linked performance and risk metrics that span infrastructure, energy, and digital systems. The executive takeaway: resilience spending across corporate functions is increasing in response to intensifying climate, cyber, and operational risks. Data indicates broad awareness and substantial investment momentum. But coordination is lagging. Spending remains decentralized across facilities, IT, energy resilience, and financial risk functions, even as risks converge materially and economic data supports integrated resilience investment. Until executive teams bridge those silos with cohesive planning frameworks, companies risk absorbing rising costs without fully reducing exposure. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.